between early October and mid-November of 2024, something extraordinary happened in the silver market, and almost nobody noticed. In just 47 days, more than 37 million ounces of silver vanished from COMEX registered vaults. That's nearly half of all silver officially available for delivery, gone in less than 2 months. It was the largest registered silver drain since 1980. And if that year sounds familiar, it should. 1980 was the last time the silver market came close to total collapse, when silver surged toward $50 an ounce and the exchange changed the rules mid-game to save itself. But here's the part history rarely tells you. The Hunt brothers weren't trying to corner silver for profit. They were trying to escape a collapsing monetary system. And in doing so, they nearly exposed a price suppression mechanism that had already been operating for more than a century. Fast forward to today. On February 14, 2025, 4 of South Korea's largest banks abruptly stopped selling physical silver, not temporarily, not partially, but completely and indefinitely around the same time. China restricted its citizens from buying physical precious metals through banks, while Russia remained shut out of London bullion markets. And right now, something is happening that violates basic market logic. Spot silver is trading higher than futures prices, a condition known as backwardation. In simple terms, people are willing to pay more to receive silver immediately than to accept a promise of silver months from now. That doesn't happen in a functioning market. It only happens when physical supply is disappearing and paper promises are no longer trusted. This story isn't really about silver prices rising. It's about a 150-year suppression system beginning to fail in real time. And when that system finally breaks, silver won't just become expensive. It will become unavailable at any price. To understand why, you first need to understand why silver matters so much. Gold is money, but it mostly sits idle in vaults. Silver is different. Silver is money and one of the most important industrial metals on Earth. Your phone contains silver. Solar panels require it. Electric vehicles use significantly more silver than combustion engines. Medical equipment, antibacterial technology, 5G infrastructure, semiconductors, missiles, and modern defense systems all depend on silver. Modern civilization quite literally runs on it. Unlike gold, silver is consumed. Once it's used in electronics or industrial applications, it's usually gone forever. Recovering it isn't economical, so it ends up dispersed in landfills, products, and waste that will never be recycled. Nearly every ounce of gold ever mined still exists. A massive portion of silver does not, for 4 consecutive years. Global silver demand has exceeded supply. In 2024 alone, the deficit was nearly 150 million ounces. That extra silver didn't come from mining. It came from stockpiles, government reserves, and exchange vaults built up decades ago. And those reserves are now being drained. Researchers estimate that future solar demand alone could consume the majority of known silver reserves within a few decades. So if silver is essential, scarce, and increasingly consumed, why hasn't the price already exploded? Because it has been deliberately suppressed. Silver manipulation didn't begin in 1980 or in 1971 when Nixon closed the gold window. It began in 1873 with what later became known as the Crime of 1873, when Congress quietly removed silver from the U.S. monetary system. Before that, America operated on a bimetallic standard where both gold and silver were money. Silver was abundant, which meant more money in circulation, easier prices, and easier debt repayment. That terrified creditors. Banks and lenders benefit from scarce money and deflation, while farmers, workers, and small businesses benefit from expanding money and manageable debt. Removing silver shifted power decisively toward creditors. Deflation followed, asset prices collapsed, foreclosures exploded, and silver never fully recovered its monetary role. Once silver was completely removed from money, Wall Street took over pricing. Futures markets allowed silver to be traded without touching metal. ETFs offered exposure without delivery. Unallocated accounts promised silver that didn't physically exist. A bullion bank could hold 10 million ounces of real silver and sell paper claims against it dozens of times over through futures, ETFs, derivatives, and swaps. For every physical ounce, there could be 50 to 100 paper claims as long as most traders settled in cash. Instead of demanding delivery, the system survived, and prices stayed suppressed. But the system depended on one thing: People not asking for their silver. That's exactly what changed in 1980. The Hunt brothers didn't trust fiat currency. Inflation was running hot. The dollar had no backing, and silver had been real money for thousands of years. So they bought it, and they took delivery. As silver prices rose, COMEX faced a crisis. If delivery continued, the vaults would empty. So the exchange changed the rules, restricted buying, raised margin requirements overnight, and forced liquidation. Silver collapsed. The Hunts were ruined, and the system survived, but what's often forgotten is that people who held physical silver didn't lose. They remained far above where prices started. The Hunts failed because they used leverage and trusted the system. Physical holders simply waited. After 1980, suppression became institutional. Silver traded sideways for decades, despite rising industrial demand. In 2020, JP Morgan paid nearly $1 billion in fines for manipulating precious metals markets. Not a theory, but a proven case. Yet nothing fundamentally changed. Because the fines were smaller than the profits, what has changed now is physical supply. COMEX's own data shows registered silver collapsing. Tens of millions of ounces have been withdrawn in weeks, while hundreds of millions of ounces remain promised through paper contracts. If even a fraction of contract holders demand delivery, there isn't enough metal. This time, it isn't two billionaires. It's nations, industrial users, central banks, and investors worldwide. South Korean banks stopping sales, Chinese restrictions, record Indian imports, and backwardation R&T. Coincidences? They're symptoms of the same failure pattern seen throughout history when paper claims exceed physical reality. The system eventually breaks the same way every time. Trading halts increase. Forced cash settlements replace delivery. Lawsuits follow. Physical premiums explode. Spot prices become meaningless. Dealers sell out. And eventually, there is no price, only availability. This happened with palladium. It happened when Nixon closed the gold window. And now, it's happening with silver. This isn't about speculation or quick profits. It's about recognizing patterns. Every fiat currency in history has failed. Every single one. Silver is unique because it's both monetary metal and industrial necessity. You can't print it, replace it, or suppress it forever. The system worked for 150 years because supply allowed it to. That era is ending, and when physical silver is finally repriced, it won't be because people decided to buy. It will be because there is nothing left to sell.